There are many ways Democrats would tax the rich. New taxes on capital income. But while these taxes take may seem similar, to operate quite differently and may have diverse economic effects. Here are some of the options of the table. A tax on accrued capital gains. International Journal of Business Ethics and Governance. The basic idea: much of the increase in wealth of the super rich never is taxed because the owners of these appreciated assets never sell them. To address this, any increase in the value of assets would be subject to an annual capital gains tax whether they are sold or not. Senate Finance Committee Chair Ron Wyden proposed a version that would apply to it. My TPC colleague Eric and his co-author Alan then have an American Enterprise Institute post a detail on more about of these taxes, taxing capital gains at death. Undercurrent follow increase in the value of unsold assets that not only go untaxed during the owner's license. That's because any increase in asset values is exempt from tax when the property passes to next generation. A simple example: Jane buys stock of $10. It is worth $100 when she dies. When her John inherits the stock, he is only taxed when he sells and only of $100. That $90 in capital gain during Jane's life never taxed. There are two ways to address this. One is to repeal the current rule called step in basis, so when John eventually says it would pay on tax during difference between $10 and $90, a more effective way would tax those unrealized gains at death, but that type of gains more for you. How to get approved for student loan forgiveness. Student loan forgiveness won't be available for everyone, but this plan is available right now. Biden gets $1.5 billion of students' debt for borrowers, but you can still apply this. Raise top income tax rates. This wouldn't entirely address the capital income problem, since investment profits still would not be taxed until assets are sold. President Biden repeatedly exposed increasing both of the capital gains tax and the individual income tax rate, but the ideas have gone nowhere in the same region. A variation on the theme is a millionaires tax that Democrats plotted late last year but seems to be plotted in the next year. Limited tax preferences. There is little interest in either party of curbing targeted tax. Indeed, Congress seems intent on expanding them even for the wealthy. Just this week, the House approved more generous tax break for the entitlement approval of high-income taxes. Wyden's budget plan. The president's new budget proposed a belt or surrenders initiative that includes three of these. For very high-income households, he would raise individual tax rates, tax accrued capital gains annually, and impose a tax on death. And given there are untaxed during the tax and raise, they'll lose a wealth tax. However, Senators Bernie Sanders and Elizabeth Warren both have proposed version of straight-up tax on the wealth of these type of simulations. There are some of difference between their plans. In general, both tax nearly all the assets of the mega rich rather than their income from wealth. While all these ideas may seem like there are some important differences. Economically, taxes accrued gains each year and taxing them one time at death are similar. This is capital true when interest rates are low and the benefits of these taxes are, but there is a key budget according to these taxes. A president looking to claim revenue inside Congress' traditional 10-year budget withdraw and profess annual It may be a long time before Binance could collect those taxes at death. And there are important administrative differences. It is much easier to tax unrealized gains one time than to do it after a year. Brokers routinely calculate the change in value of stocks and bonds, but it's much more complicated to value a privately held business and art collection. Responsibilities and doing it annually can be costly and continuous. That is why Wyden would limit the annual tax to publicly traded securities. There are also important economic difference between taxing wealth and taxing capital gains. There, with the wealthy tax, normal returns equal to say the prevailing interest rate are some at very high rates. International Journal of Business Ethics and Requirements, for example, if interest rates are 2% and 2% tax on the wealthy and it's equal to 100% tax of total income, but previously excess returns such as monopoly profits would be gained like this. By contrast, capital gains levy, whether imposed annually on a death, taxes all return to the same rate. An idea more economists prefer. Biden, for example, would it take $20 or not tax? The rate fits nicely on a bumper sticker, but doing it well.